Hi trader, this is Chris from Elite Currency with another video on Fibonacci. This time around, how to use the Fibs for entries and triggers, and we'll explain in this video what the difference is going to be. Now, as you know, we're very excited about Fibonacci, one of the best tools in technical analysis, and we have a whole series on it. You can check the entire video series on YouTube. First of all, though, be aware that trading for exchange and global financial markets are considered high risk and may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. This video is for informational and educational purposes only, and by continuing watching this video, you agree with this disclaimer. Alright, so Fibonacci's as a tool for trigger and entries. Well, basically, there are two ways we can use it. As a discretionary way, when making analysis, basically using the Fib tool, placing it on the swing highs and swing lows that we think are useful, or using a very strict rules-based strategy kind of, or system perhaps even, that says, okay, I only move this Fibs when this and this happens. So those, of course, are two different ways of tackling the market and using Fibs. First of all, we're going to be discussing the number one in this video, and the second point will actually show you an example of such a strategy-based Fib system next week. So basically, besides, of course, the Fibonacci tool that we use for determining support and resistance and use to help out filter setups like we discussed last week, they also offer a very clear and precise method of taking trades. Now, with entries, all right, and that's here I'm going to explain the difference between entries and triggers. Obviously, I'm looking at taking a setup and actually just going into the market right there, right then. I'm not waiting for anything else. So in that case, I'm really using the Fib as an entry tool. I personally do this when trading with discretion. And once again, by the way, discretion is using analysis, using one's own judgment of various tools to make a case-by-case, trade-by-trade, scenario analysis and to see if a trade is desirable. All right. Now, with non-discretionary would be then the opposite, where you just have those strict rules. Now, the lower time frames, such as the 15, 30, and 60-minute chart, offer a balanced method of entry because we have a stop loss that's not all too far away, and a direct entry order is possible. Now, if we zoom out to higher time frames, we're looking at 4-hour, daily, weekly. Stop loss size becomes very wide, and also the time that a trade has to develop before reaching the target and going into our way will take long. I mean, we're talking about weeks perhaps. So in many cases, for many traders, this is too long and not enough reward for the account to grow that account to a higher size. Of course, if you're trading perhaps 10 million, then that's a different story. But with those time frames in mind, it's more difficult to trade just from a time perspective, keeping on to that trade and a very wide stop loss. So that's why I use personally Fibs on a higher time frame like an area of interest. If it gets there, it's valuable information and perhaps still worth a trade, but not just based on the Fibs, but based on some reaction to it, some confirmation. And I'll talk about that in just a second. First of all, talking about entries first of all, here's just a very simple example on the 1-hour chart, pound dollar. You can see when price gets to the 88.6 Fib or the 61.8, as in this example, those could be entries potentials there right at these Fibs. Now, of course, sometimes we might not get the exact turning Fib, like in the first example here. If I'm trading the 78.6 or perhaps even the 61.8 Fib, obviously the price goes against my position a bit before turning around. But if the stop loss is below the 100 level there, below the bottom in this case, with the top in the downtrend, then the stop loss is safe even though price goes to a lower Fib than anticipated. Of course, the best would be to trade indeed the 888.6, but not always would that work out. And sometimes I might choose a Fib that's higher, or I might split the setup into two parts sometimes, as long as the risk in total stays the same as per your risk management plan. So in these cases, though, clear Fib entries potentials, and you can see nice entries with a decent stop loss size, not something extraordinary huge. So these are possible to take pending orders, basically a buy limit in this case, or sell limit with a downtrend. And these are very tradable as is, right? If the analysis says that the trend is up, or we expect a turnaround to the upside, then you can use Fibs for those entries. Now, there's also a way of using a trigger. And there are some good advantages of the trigger and waiting for some reaction in the anticipated Fib zone. Now, the disadvantage is that there's a worse price, and many traders don't like waiting for reactions or confirmations just because the price is worse. And that is very true, and one of the disadvantages, certainly so. And that's why I still sometimes go for the pending order. But the market order has an advantage as well, because first of all, we know that price is indeed stopping, or at least there's a chance that it will, because there's a confirmation of a price action at that zone. The confirmation of the price action means that a tighter stop loss, a stop loss could be used below the candle, about 20 to 25 pips, typically on a 4-hour chart or daily chart. Below that candle, I wouldn't go 1 or 2 pips below the candle, but obviously there is a potential to use a tighter stop loss, and especially on a daily chart, where if you use the top or bottom, it could be hundreds of pips. That obviously is too much. And then if you use a candle, it could be 50 or 70, and it's much more doable. And the trade gets into a positive reward to risk a lot quicker. It removes the guessing, because if you place a fib on the chart, does the price really stop at the fib? Especially if you're less experienced, you might be using fibs that are not the best fibs. And of course, hopefully after going through our entire series on Fibonacci, you'll be better at that. But still, anyone who is starting fibs will have problems with placing fibs, because it's a discretionary thing if you use it for analysis, and you might place it at the wrong times, at the wrong swings, at the wrong moments, and that is just not as effective. So before you get experience and before you understand what are good fibs or not, then it's good for less experienced traders, and the trade is completed quicker in general. So there are some good advantages of looking at triggers. So let's take a look at this example, the daily chart. All right, so looking at the euro-yen daily, you can see price goes up to the 61.8 fib, and if you take an entry order there, technically the stop loss would have to be way at the top. Well, this is of course undoable. This is a 1,000 pip or so stop loss, which is gigantic. So that's not practically possible on the daily chart. Also, will price stop there? We don't know, because in this case, look at the 50 fib. Price goes to the 50, stops at the 38.2, goes to the 50, but then stops at the 61.8. So sometimes yes, sometimes no. In my experience, about 2 out of 3 times, the fib levels are respected. So if we use a confirmation, such as for instance a clear price action signal, like here, right, a clear pin bar, we got bullish candles, exhaustion with the wick on top, and the bearish candle right at the 61.8. That is a confirmation signal, a clear one, that price is stopping and respecting that fib, the daily fib. So I have interest in that daily fib, but I don't want to trade it right at that level. But when confirmation is given, right, then the things change. I don't have to put a wide stop loss. I can use the candle high after this daily candle is closed, of course, as my stop loss, 20 to 25 pips above that. And I can enter upon the retracement of that candle, or even upon the closure of that candle. Obviously, the retracement would give even a better trade. So if you wait for the retracement of the pin bar about halfway and the stop loss above, you're looking at a tight stop loss of about, let me check, it looks to be about, let's say 80 pips perhaps, 100, not much, obviously a lot less, less than 100 probably, maybe even, if depending on the candle, it could be even 60. And the trade goes, well, some few hundred pips our way. Then it makes another hook back to the same fib, shows again pin bars, and potential second or continuation of that trade for even more downside. So there's a lot more options here on getting the confirmation of price action at the fib. So once again, we might get the worst price because we're waiting for confirmation, but we know that price stopped at the 61.8 of the daily euro-yen. We got a tighter stop loss and therefore more options to exit the trade at a better R2R. It removed our guessing whether that fib will be used, which is especially important for less experienced traders. And ultimately, the trade just developed a lot quicker. Let me show you some other examples. Ultimately, here, for instance, the pound dollar, a bullish candle right at the 886 fib. That's on a 4-hour time frame. And you can see as we fib along this upside that, on a 4-hour chart, it's just very useful to get some kind of reaction here. This bullish candle, or perhaps even right here, you can see this bullish candle at the 38.2 fib. And as we go along, you can see that, bullish candles, or, an uptrend, of course, bearish candles in a downtrend at these fib levels are very useful for that confirmation. And, this depends, even it could be useful on a lower time frame like the hourly, but it's less needed because, of course, of the fact that everything is less, in size. If we look at here on the hourly chart, for instance, a direct entry rate to 61.8 is still okay-ish, all right? Especially, of course, on lower time frames, we're looking at fibs that are not that drastic. For instance, here, if one fibs this from here to here, 61.8, right, would not have a dramatic stop loss, about 60 pips. But if you wait for the candle confirmation, right, you get a worse entry, but the stop loss is a bit lower, 50 pips instead. So that's the balance. On the lower time frame, it's possible to take the direct market order entry, the direct pending order or the market, and both give options, in fact, whereas higher time frames, the trigger is a better option. And obviously, it is important to realize that if one uses this for lower time frames and uses pending orders or market orders at the fibs, you have to make sure there's a trend. You have to make sure that, of course, there is a momentum going your way, because that's a very important criteria that price indeed continues with that momentum and that downtrend. Because if price is in a range, then this is not important. The fib will not have any relevance. That's an important thing when you do this exercise. Lower time frame, make sure that we have that momentum to the downside or upside, of course, in an uptrend. Well, in the next video, we're going to talk about the non-discretionary way. We're going to be talking also eventually about which swing high, swing low to use, the validation levels, stop loss levels, all of that in the upcoming weeks. Write to info@elitecurrency.com to get your free ebook on Fibonacci, and wish you all good trading. Cheers.